Types of financing. Now, financing is where businesses seek capital either through short-term borrowing or long-term borrowing. The word term is, or the length of it is relative, because short could mean under 3 years and long could mean anything above 1 year. So let's define the two terms: short-term financing, long-term financing. Short-term financing occurs where an agency lends a business a small sum of money which is repayable in less than a year. Definitely not more than 3 years. So the general rule is less than a year. Long-term financing, on the other hand, occurs where an agency lends a business a large sum of money which is repayable in more than a year. So short, you get small sums of money. Long term, you get large sums of money. What do we already know so far? But short-term financing is pursued if the business is having temporary cash flow difficulties, or perhaps the business is in its seasonal downtime, like what will happen, say, in a tourist industry or the fishing industry, where you have seasons. Now, the characteristics of short-term financing, based on what we've learned so far, would be that loans will constitute small sums of money. Secondly, these loans can be approved within minutes, so it doesn't take long to get your approval. Those loans do not require any collateral support, so you don't have to bring your house and your land or any such thing to get this loan. You get it relatively unsecured. The fourth thing is that these loans come at a high rate of interest, and the loans require a payback in a short time span. So those are the characteristics of short-term financing. What do we know there? What types of short-term financings can we get access to? Well, there are several types. I have listed 8, as you can see here, starting at trade credit, bank loans, all the way down to venture capital. So let's examine them one by one. What is trade credit? Trade credit is where the suppliers allow the business to purchase supplies without paying right away. So this is a typical thing you get out of a 3 months period. You sell your goods, you make back the money, you pay off the debt. Bank loans, well, this should be easy. Everybody knows what a bank loan is. So bank loans is where banks lend the business money but requires it to repay with interest within a short period. Okay, anywhere between 1 to 3 years. So again, you want to get $5,000, $10,000, you can easily go to the bank, and once your name is good, you can get that money without any problems, and you have to repay within 12 to 24 months or 36 months afterwards. What are promissory notes? Now, promissory note is a document written by the bank or some lender, which gives a promise to pay a debt at a specific date or on the demand of the creditor. Now, you usually use this sort of note if you're buying goods from an overseas supplier. So they will want to guarantee that they'll get their money. So you'll get the bank to give you a promissory note. Advances from customers is slightly different. Now, this is where funds are collected from the customer before they have been provided with a service. Well, we know this as like what we call prepaid subscriptions and so on. So you pay your money up front, and then throughout the year you get your service, which will be a copy of whatever it is you subscribe to. Factoring is where the business sells its accounts receivables or its trade debtors, in other words, at a discount to another business in order to get cash right away. So you have some serious cash flow problems. You need the money right away. You could sell the debt that someone owes you to this other business, a factoring business, at a discount. Obviously, you get less money than you are owed, but you'll be able to pay your debt. Crowdfunding, well, crowdfunding, as you know, is a popular thing now, usually online via social media. And this is where the business borrows, as it were, should put that in inverted commas, small sums of money from a large number of people to fund a project. And you know how it goes. Every little bit will count. So you put it all together, you reach your target. So we have two other sources, or two other types. You got angel investments. And an angel investment is where funds will be supplied by an investor to help you get your business off the ground, especially when no one else is willing to take that risk. So angel investors usually have startup businesses that look kind of low risk, etc., but they're willing to put their money there to get you going. On the other hand, the venture capitalists or venture capital, these are funds also provided by investors, but they are provided to get a share in a business with a high growth potential. So if your business looks like it could make a lot of money, venture capitalists will come along and try to get you going. Alright, so what do we know now about the long-term finance? Well, long-term financing is pursued for different reasons, obviously. For example, if the business is investing in a capital project, or it intends to expand, or it wants to do some research and development, you're going to borrow large sums of money, not little bits. So therefore, if you look at the characteristics of long-term financing, we will see that one, the loans will be made up of large sums of money, as I said. And these loans, however, will take quite a while to be approved because this is a lot of money that we're talking about. So they want to do a lot of background checks and make sure you're worthy. And thirdly, these loans require valuable collateral support. You have to bring something of value to back your demand for the loan. So people put their houses or their real estate or whatever in order to get these loans. And these loans, however, come at a low interest rate. So unlike the short-term financing, which are high interest rate, these are low interest rate loans. And they're repayable over an extended period. So usually you have like 5, 6, 10 years thereabouts to pay this money. But one thing about long-term financing is that once you engage in it, it will negatively impact your current cash flow because you need to pay that money every period over a long period. So you would have to really adjust your cash flow. Right. So what types of long-term financing are there? Well, I have 5 that we could look at. Insurance, shares, government agency loans, mortgages, and debentures. Well, insurance we're familiar with. You can use the benefits of your insurance policy as collateral to secure a loan either from the bank or the insurance company itself. All right, so that's one way you can get your finance. Secondly, you could sell certificates of ownership, what we call shares, to the investors in order to raise the funds that you need for your long-term project. But in this case, though, remember your business has to be incorporated. It has to be some sort of registered company. Well, government agency loans. These are loans at very low interest rates provided by specific state agencies to assist various types of businesses. So the business obviously has to match the agency's portfolio, and they will help you out with your long-term projects. Mortgage, again, I guess most people are familiar with these because a lot of houses are in mortgage. So these are loans where the cash is distributed upfront to the project, and repayments with interest are made over a set time span on the pain of losing the high value collateral that you would have put against it. For example, you may have had to put your land, and you could lose that land if you don't pay. All right, so that's a mortgage. The debenture, on the other hand, and this definition I'm giving you is used in the Caribbean and the UK, is a long-term debt security, or we call it loan certificates, with a fixed guaranteed rate of interest. And these are secured against the company's assets. Now in the United States, they just use it against normal credit, but from our angle, it is secured against your company's assets. Well, that's financing. So I want to thank you, keep revising, and hear you again soon.